Europe has opened as expectedly in the red on the back of those weak jobs numbers you saw come out of the US last Friday. The indices in front of you, that's Paris, which is down about 1.5%. Frankfurt's down about 1.3%, and the FTSE is down about a percentage point. But to get a better outlook on what to expect from European equities going forward for the remainder of this week, we've got Gustavo Bagatini, who's a senior economist at EBC Capital Markets, who joins us on the show from London. Gustavo, to begin with, what would you say the big triggers you'd be looking for the remainder of this week from the markets?
Well, good morning from London. I think, as you rightly said, European markets are opening up today, and they have a little bit of catching up to do after the long break, after the holidays here on Friday and Monday. We've had a string of data from the US, from China, which hasn't really helped sentiment, and really the focus here will be, I think, on the news coming out of bond auctions, and especially Italy on Thursday. If you recall, last week we had a Spanish bond auction which was much weaker than expected, and that really triggered off renewed concerns about the sovereign crisis in Europe. And in the absence of any first-tier data this week or any major events, any major meetings, I think the focus will squarely be on what the bond markets are pricing in.
Gustavo, you did mention that there will be a lacquer in terms of data, but you had the news that the US Fed is also unlikely to introduce a QE3. How do you expect this is going to impact the markets across the globe, particularly for Europe?
Well, I think the Fed position is a little bit more balanced than that as to whether we do see more QE or not. Clearly, there is focus on that on Europe in terms of what the implications will be, but in terms of monetary policy in Europe, I don't think that's going to change very much. I mean, next month we'll also have question marks as to whether the UK introduces more QE or not. In the meantime, the ECB seems to be comfortably on the sidelines for the time being, with their LTROs in place and with monetary policy very accommodative, as the governing council puts it. So I don't think the focus will be there. I think the focus will turn back to the macro picture. We're getting industrial production data this week. We'll get some fiscal data in a couple of weeks' time before we're getting the first quarter GDP in May, which should confirm that the year is in recession. And really the question mark will be as to whether the macro backdrop in Europe is supportive of any sort of recovery, or whether the recession is going to be deeper and longer than the market is currently expecting.